brief introduction about myself. I would not take much time. I am a SEBI registered research analyst and a certified financial planner as well. I started my investments into stock market in 2006, but that's when I started earning. And but my interest in stock market is, I would say, hereditary, because my father is into this domain since 1978. That's 42 years. And the wealth which I've seen my father create wealth into stock market. Usually what people have created in real estate in India, I've seen my father do that in stock market. So that's where the conviction comes from, and that's how why significant majority of my savings and investments are into this market. So talking about today's session, I have dealt with many investors in last 14 years. Uh, Thousands of them. I've trained them. I've taken up courses and sessions, and I've one-to-one coaching. I've realized one thing, that people are not aware of what returns you should expect. So see, if you don't know where you want to reach, let's say you want to go somewhere and you open your Ola app, but if you don't put the destination in your Ola or Uber app, it will not start, right? I mean, you can't really move from where you are. So unless until you know what you should expect, what returns you must get, till then it will be like, just doing what you would just doing random things and expecting good things to happen to you. And that's what leads people to make investments which are not worthy, right? So once you're clear what you want to get, then you would find out ways to achieve that target, right? So before we start, as Unnati was mentioning, there is a free giveaway for all the participants who stay till the end. In the chat box, I'll share a link wherein you can get these two things. One is an ebook, a document on curated videos and articles. So as a part of my own learning, I watch a lot of videos, I read a lot of reports and articles. And whenever I find something really insightful, something which has been explained in a very simple manner, I take a note of that. So there's a document which I have created, which has got about 22 videos and 12 articles, which are on stock market, mutual funds, insurance, taxation, real estate. So I mean, anything and everything concerned to this domain. And there are some generic videos as well. So I'll give away that document free of cost. And there's a premium video which I have created, which talks about real estate versus equity. So both have created wealth for Indians, be it property or stock market. We'll in the video I'll explain what are the pros and cons of both the sides. Right? It's a video which will give you a idea what do you want to, in which direction do you want to go, and how balancing you want to do between the two investments. Right? So these two are it's worth about 6,500 rupees, which I'm giving away free of cost for only participants in this webinar. That is Loanwalle webinar. So just stay tuned till the end. Now, starting with the session.
So Anupam, I've muted everybody. You can unmute yourself once and then we can start.
Yes,
everybody
yes.
Facing, so there are a couple of people facing network issues when they're trying to join. So I'll sort it at the back end. Meanwhile, you can start, and we'll keep it a highly interactive session. So everybody who's in the webinar, please do write, comment, chat with the host. Yeah. So let's get started.
Sure. Thank you, Nadi. Yeah, so I was talking about these two giveaways. Now, starting, I have some. You can post your questions in the chat box. I'll once in a while I'll keep checking that and keep answering as and when possible. If I miss on to your question, please keep it on hold. In the end, at the end of the session, I'll take up all the questions. Yeah. Yeah. So starting with inflation. Well, this is one figure. This is and this is that obstacle which is there between you and your financial freedom. Now you might say, Anupam, what are you talking about? Inflation we all know about. I mean, I'm from maybe you are from commerce background, maybe some of you are CAs, and even if you're not from commerce background, you understand what inflation is. Consider the inflation figure which you have been anchoring in your mind, the inflation figure which you think you have witnessed in last 40 years is wrong. We'll look at the actual inflation which your family has witnessed or suffered in the last 40 years. So if you look at the government figures, Government of India figures of last 40 years, the inflation in India is around 7.5% compounded annually. So every year your inflation has increased by 7.5% every year in last 40 years. Now, why am I talking about 40 years? You look at any family, or any individual, you start working at 22, 23, 25 years of age, you work till 60, 65 and you retire. So the 40 years is the working life of any individual. And in these 40 years, you create your own wealth, right? So when I look at any figure for last 40 years, it is the most unbiased figure I can have, right? If I look at last 5 years, property market has not done well, but if you look at last 40 years, people have made money in property, right? So if you look at last 5-10 years, gold has done well, but if you look at last 40 years, you'll be surprised looking at the returns. So last 40 years will give me the unbiased figure about any investment type or investment class. Yeah. So that's why I'm talking about 40 years. So government of India says inflation is 7.5%, but the inflation of your household and my household is much more than that because of something called lifestyle inflation. Let me give you some examples. Uh, 20 years back, this mobile phone was just introduced in our lives. It was a luxury, right? Today, every member of the household has got the mobile.
Yes.
Every 2-3 years, you change it, and every month you pay the bills. So it came as a luxury, and it has now become a necessity. Let me give you some more examples. I remember in 90s, most of the people had their first car as Maruti 800 or Maruti Zen, right? Now, if you look at people who have just started their career and just started earning, they'll take those easy loans and go for a bit better car, if not at least not Maruti 800 or Zen or whatever Alto, whatever we have now, right? So that's called lifestyle inflation. You aspire for more from day one. Yeah. Another example. I remember in 90s in our school days, going out for dinner used to be an event. You know, mummy papa bahar khane pe leke ja rahe hain. It used to be like that. I think now, I mean, barring the COVID period, we end up eating 5 times in a week outside. Either we order or we go out, whichever ways, right? So that adds to your inflation. That adds to your expenses, right? Last example: 20 years back, how many flights you used to take? How many vacations you used to do? And what quality of vacations you had? Usually we used to go to a city where we had relatives or friends and used to stay at their place. Now you book a 4-star or a 5-star hotel and you go in a flight. So you look at the number of vacations and the amount of money you are spending on that. All this is called lifestyle inflation. One last example: look at the number of TVs and number of air conditions you have. I remember when the first AC came, it was an event again in the house. Now every room has got an AC, including the living room and the dining room. Every room has got a TV almost, because everyone wants to watch what they want to watch. Yeah. So all this adds to the inflation. Now, before I give you some figures, I want to know from people in the group, from the participants. 1980, 40 years back, maybe you had a joint family or a family was. Even a nuclear family was big because mostly people used to have 3 or 4 siblings, even more. What do you think was the household expenses of your family in 1980 on a per month basis? 1980. I'm looking at the chat box. I want to see some numbers. What do you think was the monthly expenses of your? Maybe you were not born. You are in your 30s or early 30s or 20s. But maybe when you sit with your parents or grandparents, there's a talk. हमारी तो income इतनी होती थी. This was my salary. This was my income, and this is what we used to spend. So, what do you think was the monthly expenses of your family in 1980 for a family of 4? It's not 1990. See, a lot of people confuse 1990 and they have that anchoring in the mind for 1990. It's 1980, 40 years back. For a family of 4, if you had a family of 6, 7, or 8, reduce it proportionately, because we want to do an apple to apple comparison. For a family of 4, what was your household expenses on a per month basis? Okay, I'm getting some figures: 4,000, 5,000, 10K. 10K is, I think, on a very high side. Maybe depends on what status of your family was. But yeah, Yogesh says less than 1K, approximately 5K, 2 to 3,000. So I'll tell you the kind of figures I have got when I do these sessions. It ranges from anywhere between 300 rupees per month to 2,000 rupees per month. Depends on your family size, depends on which city or town or metro you were living in. But the kind of salaries people had was 300, 500, 1,000, 2,000 rupees, 1,500 rupees per month. And that was the income. You will save some money out of that, and then the remaining you will spend, right? Anyway, let's keep it anywhere between 500 to say 5,000 rupees or 2,000 or 3,000 rupees per month. Fast forward to 2020. Today, a family of 4, again, if you're a family of 2 or 3, increase it proportionately for a family of 4, 2 children, their school fees, your monthly expenses, your yearly expenses. What do you think are the expenses of a family of 4 today in 2020 for a per month basis? And when you see, one more thing, when you check that, check these things. There are some expenses which are monthly, some expenses which are quarterly or half yearly. For example, your schools, your children's school fee. Some expenses are yearly. For example, some new furniture, some new gadgets, some new phone, some new watch, whatever. Your luxury expenses will also come. I'm not just talking about your grocery expenses. I'm talking about whatever you spend in a year. You go for a vacation, for a shopping, for some new kitchen appliance. People have bought dishwasher. So something or something new will keep on adding to your life every year. It will come in the form of a luxury and it will become a necessity. So what do you spend in a year? Divide that by 12 to come for the monthly actual realistic figure. And you should include your EMIs as well. Why should you should include your EMI? Because whether you're paying that EMI for your house or for your car, that's a part of your lifestyle. And you have to pay that for 10, 15, 20 years. So that expense will not go away. And by the time the EMI gets over, you will start spending more on other things, right? So what do you think is the monthly expenses for a family of 4? Not 1, not 2, not 3. For a family of 4, including your vacations, including your shopping, including your children's school fees, including your once in a while or some renovation of furniture, your appliances, and anything and everything. I want to see some more numbers. And you can, if you can also tell me which city are you from? I mean, let's say you're writing 40K. So 40K in which city? Including your rent, whether you're paying a rent or EMI. I mean, that's whatever is going out of your pocket. That's an expense. And whatever you are paying, your neighbor will not pay anything to your, with concern to your expenses. So Ashish says 50 to 60,000 in Ahmedabad. Okay. So I'll tell you, I stay in Bangalore. We are a family of 3, and I'm spending around 1 lakh including rent. And rent actually forms a major part of that. 1 lakh including rent. That includes, see, COVID times expenses have reduced, but I'm just talking about the normal times. We will get back to those normal times, I believe. So we will go for vacations maybe twice in a year. We'll do some shopping every now and then. Some new gadget will come in the house in the form of maybe a watch or a new mobile phone or something or the other. 55K per month, 50 to 60K, 40K per month for Indore. For a family of 4, again, I'm repeating, if you are a family of 2 or 3, please increase accordingly. Schools, do any idea what is the fees of the schools for children? Let's say your child is between 5 to 15 years of age. Per month fees in a city like Bangalore is anywhere between 5,000 to 20,000. Lower side 5,000 is like very, very low, goes up to 20,000 rupees per month also. Include that for 2 children. Yeah. All right. So let's see where do we stand. So anywhere between 500 rupees to 2,000 rupees in 1980 has become around 50K to maybe 30K to 40K to 50K, or maybe for some people up to 1 lakh. But though 1 lakh, no one has said that apart from me. But yeah, 50K, 60K, 40K is something a lot of people are saying. Yeah. So your expenses have gone from say 1,000 rupees to 50,000 rupees. Let's take some average. From 1,000 rupees per month to 50,000 rupees is 50 times. If it was 500 rupees and it has gone to 50,000, that's 100 times, right? In any case, if your expenses have grown by 10% compounded annually in last 40 years, let's say it was 1,000 rupees in 1980 and it increases by 10% per annum, it will become 45,000 rupees per month today. So if you are someone whose family was spending 1,000 rupees in 1980 on a per month basis, and now you are spending 45,000 rupees per month in the 2020, then you have witnessed an inflation of 10% compounded annually. That's your inflation. It's not some theoretical number. It can vary for different people, but let me give you some calculation to help you with that. So if it was 1,000 rupees and you increase it by 10% every year, it becomes 45,000. If you increase it by 12%, it becomes 93,000. That's like almost 1 lakh rupees. And if for some people might say I'm spending 2 lakh rupees per month, including my EMI, rent, whatever, that's 14% inflation. So bare minimum is what I have seen, talking to hundreds and thousands of people. 10% is the bare minimum inflation anyone has witnessed. Now, why are we talking about this? Why is it important? If this is your inflation, 10%, it means your investments should have made at least 10% returns so that you remain afloat, so that you can beat inflation and create wealth and fulfill your financial goals. If you're saving 100 rupees today and your inflation is 10%, it means you have to spend 110 rupees next year. If you are saving that 100 rupees and putting it in some investment, that investment must give you at least 10% return so that you have 110 rupees next year. Else you will go down the stairs. You will not go up. You will erode your wealth rather than creating your wealth. And 10% return should be post-tax. Tax is again something people ignore totally while calculating the returns, whether it's real estate or stock market or wherever, or gold. So whatever returns you make, whether you make it in FD or property or stock market or mutual funds or gold, you have to pay some tax on that. So after paying taxes, you should have 10 rupees return, 10% return. So maybe you should make 11 or 12% return so that after paying taxes, you have 10% in your hand. This is just to remain afloat. This is not to beat inflation. This is just to match inflation. Yeah. Let's look at some examples. So broadly, your investments are into these 5 asset classes. Either it is into property, or it's into fixed income, fixed deposit, RDs, post office, EPF, PPF, debt mutual funds, or it is into stock market, equity, stock market or mutual funds, or it is into insurance, or it is in the cash form. I've included gold into cash because that's very liquid. You can give gold away and expect liquidity, cash out of it anytime. Now, again, a question to all of you. I'll look into the chat. Out of these 5 broad asset classes, which ones do you think have given more than 12%? Why I'm saying 12%? Because after taxes, you should be at 10% return. So 12% if you make, then maybe you will be able to have 10% in your hand, right? So out of all these 5 broad asset classes, which asset class do you think has beaten inflation in last 40 years? That is, it has given more than 12% returns compounded annually every year on an average. Sometimes it will give negative, sometimes it will give positive. But which ones do you think have given more than 12% returns in last 40 years average?
I would think real estate, but everybody can put in their comments in the chat box. But I am blown. Like, if I was making 10% as interest, but the inflation was 7%, I never realized I was just making 3% because baki paisa to inflation kha gaya. And
right. And inflation actually was not 7.5%. It was around 10% for you as well. So I mean, 7% is what government was saying, but your expenses, your lifestyle was adding to that extra 2-3% inflation.
Oh, makes a lot of sense.
Yeah. So real estate is there. Yes. See, people have made money in real estate. Real estate has, if I talk about plots or land, real estate has given returns more than 12%. Equity, someone is saying equity has given returns. What else? Gold. What do you think? Gold and insurance. Anyone who thinks gold and insurance has given more than 12%? Fixed income, I believe all of you would agree it has not given. So let's look at it from a very common observation and common sense perspective. How many of you know anyone in your life who has made wealth by investing in fixed deposit or PPF or employee provident fund, or maybe RDs, or maybe debt mutual fund, or maybe Sukanya Samriddhi Yojana or Kisan Vikas Patra, all these government backed schemes and safe investments? Do you know anyone जिसके लिए हम ये बोलते हैं ना, this guy invested in this safe investments and he is today a rich guy, a wealthy guy? No one, right? How many of you have heard that someone saying that this guy made some very wise decisions when he was in his young age? He took some excellent insurance policies, and today in his retirement, he has got amazing money from those insurance policies, and he's a super rich guy today. How many of you have heard people creating wealth or becoming financially free by investing in insurance companies, insurance policies? If you have a yes answer, let me know. Yeah. Gold, you'll be surprised. You must have seen the recent rally in gold in last 5-10 years. Gold has given returns, but you'll be surprised. Gold returns in last 40 years is in single digit, less than 10% compounded annually. You can go on Google and check the 1980 gold return and 2020 gold rate, and you can do your maths. 5 years back, someone would have told me gold will give this much return. Anyone would have invested. It's not about retrospect. It's about, can we really predict what will happen to gold in next 1 year, 6 months, or 5 years? So gold has not beaten inflation in the last 40 years. That's why you will again not find people who invested heavily in gold and now they are rich because they invested in gold. Yeah, but you will find people for whom you might have heard people talking, like in your circle, in your family, in your extended family, neighbors and colleagues, that this guy has got properties worth 100 crores. This guy has got equity or stocks worth 200 crores. You must have heard these kind of stories. Why? Because these are the only two asset classes which have beaten inflation in India. And this is the basic economic concept. It is not unique to India. You check any growing economy's history of last 10, 20, 30, 40, 50, 100 years. Only property and stock market has beaten inflation because these are the two assets which grow as per the economy of the country. Interest rates will go down as the economy grows. You know the interest rates in developed economies, right? What are the interest rates in US and Europe and Japan and Australia? 1%, 2%, 0.5%, close to 0%. So returns in your FDs and your safe investments and your insurance and all these will keep on going down as India grows. That's what has been happening in the last 40 years. So as per common sense and common observation, these are the only two asset classes which create wealth. Why? Because these are the only two asset classes which beat inflation. Nothing else can beat inflation. Whether you like it or not, that doesn't matter. This is the basic economic concept. It's not because I am saying it. Yeah, let's do some numbers. We call this table as magic of compounding. We did some calculations on Excel, and we took some numbers. For example, let's say I was investing 5,000 rupees per month, which becomes 60,000 per year. 5,000 multiplied by 12, and I keep on doing it for 40 years. Now the big assumption here is I am not increasing my investment. I am keeping it 5,000 rupees. So 5,000 rupees might be big amount for someone today, but after 5 years, 10 years, 15, 20, 30, 40 years, it will become a very small amount, right? For example, spending 2,000 rupees or 3 or 5,000 rupees per month was a big thing in 1980. Today, you maybe end up spending it on one meal. Yeah. So that's how inflation works. That's why it's called magic of compounding. So I end up investing 24 lakhs in a period of 40 years. Please mind, I'm not investing 24 lakhs on day one. I'm investing 5,000 rupees per month for 40 years. So over a period of 40 years, I'm investing 24 lakhs. Yeah. These are the different rate of interest. Saving banks, you get around 4%. Now it has reduced. I'm keeping it on the higher side. FD is around 7%. FD, gold, insurance, bond, PPF, RD is given between 7 to 9%. Inflation we saw is 12%. I mean, you need to make 12% so that you have 10% net returns in your hand after taxes. And stock market real estate has given between 12 to 20% on an average. Yeah. On the left hand side, you see the number of years, 5, 10, 15, 20, up to 40 years. I'm not taking less than 5 years because when we talk about equity market, we highly recommend that don't invest any money into stock market or mutual funds which you need in next 5 years. Your minimum investment horizon should be 5. That's why we are kept it for long term. Now, if I end up investing 5,000 rupees per month in savings account and I'm making 4% returns, after 40 years, 24 lakhs will become 0.58 crores. That is 58 lakhs. Simple math, you can always cross check in your Excel sheet. So when you're investing 5,000 rupees per month for 40 years, you'll end up investing from your pocket 24 lakhs. That 24 lakhs will become 58 lakhs after 40 years at the rate of 4% returns. Yeah, simple. The next two figures, 7% will give you 1.24 crores. At 9% returns, you will get 2.12 crores. And at 12%, you will get around 5 crores, 4.89 crores. Now, again, a common observation. If any couple who is in their retirement age today, 60, 65, 70 years, if they have got 5 crores worth of assets, which they can liquidate and put in their FD, their retirement is sorted. 5 crores will give them enough liquidity, enough interest income, which can meet their monthly expenses. 5 crores is what you would have got if you were beating inflation in last 40 years. Yeah. Let's look at next. One more thing. Look around you again. You will find two kinds of people. One, people in the age of 60, 65, 70. One, who are dependent on their children financially. Two, who are still working at this age. Why is it so? Because these guys, it's not that they did not make money, they did not earn money, they did, but they ended up investing in so-called safe assets, safe investments, which which would never beat the inflation. So even after 40 years of their career, 40 years of their working life, they have around maybe one and a half, 2 crore rupees as total assets, combined all the different kinds of asset classes, which is not enough to meet their living expenses for their entire retirement life. Yeah. Let's look at the figures for 15, 16, 18 and 20%. This is just 5,000 rupees per month. By the way, you cannot invest 5,000 rupees per month in real estate, but just for the sake of example. Yeah, you can hear me?
Yes, we can hear you.
Sure. So look at the figures. 15% gives you 11 crores, 16% gives you 15 crores, 18% gives you 27, and 20% gives you 48 crores. This is just 5,000 rupees per month. What's important is how much you're making returns percentage wise and how long. It's the magic of compounding is in the number of years. Yeah. Now just think about it. All these safe investments which you talk about, the guaranteed investment, are these really guarantee or a guaranteed loss? Again, look at your family. Forget about others. Look at your family. If your family has made more than 12% returns on an average on their investments in last 40 years, you are sitting on assets today, be it in the form of stocks or be it in the form of properties. If your family has not made more than 12% returns in last 40 years, you do not have assets. Not that you're not having a lavish life today. If you're earning well today, you must be having a lavish life, but you don't have any assets to back you. You don't have that financial freedom. You have to work to fulfill your monthly expenses. You cannot be financially free if you don't have assets. Look at your family, look at your maybe neighbors, your extended family, your colleagues, your friends. You will find this everywhere. Those who have made more than 12% returns on an average, they are sitting on assets today. Rest of them are not. Same table. Let me go to the next table. I have just changed the figure to 20,000 rupees per month. Look at the last four figures: 46, 61, 109, 194 crores. Now, a lot of people tell me when I show them these figures that these are just for the sake of presentation. These figures are too huge. 40, 60, 100 crore rupees. We don't need this kind of money. Again, that's why it's called magic of compounding. You think you don't need this kind of money. See, just look at the figures. What has happened in the last 40 years? 1,000 rupees per month has become 50,000 rupees per month. That is 50 times. What is 50 times of 50,000? 25 lakhs. 50. If it becomes 50 times in next 40 years, it is 25 lakhs. Yeah, per month. So now, do you think that these numbers are big? They look big today. Spending 50,000 per month. Imagine someone told your grandfather in 1980 that your family after 40 years will spend 50,000 rupees per month. How he would have reacted in 1980? 50,000 rupees per month monthly expenses.
They would have actually said कि ऐसे थोड़ी उड़ा थोड़ी रहे होंगे पैसे, but makes a lot of sense.
Yeah, so the figures will look big today because I mean we are talking about 40 years later. So, but this will become a very normal thing. look at what expenses you can you will have in 2060. You have to prepare for that. You have to beat inflation continuously for next 40 years. Yeah. Another table, 50,000 rupees per month. Look at the last four figures. Now coming to one more thing I was talking about in the beginning. It's important for you to know how much returns do you need to make. Anything above 12% is excellent. Please stop aiming for 25, 30, 40, 50% returns. It's not practical. You might make it once in a while when the market is going up, or real estate market is up, or stock market is up, or gold is up, but that's not sustainable for 10, 20, 30, 40 years. If you keep on targeting that, you might end up losing money rather than making money. If you and I can make more than 12% compounded annual returns on our total investment put together on an average, the kind of money you will have will be more than what you need. And purposely I've not taken more than 20% figure in this table. Why? Because Warren Buffett, who is one of the top 5, top 10 richest person in the world, has made only 20% returns in last 65 years of his life. Not many people know that 20% returns compounded annually is his performance in last 65 years of his. He's 90 years old now. Started investing at 25. I mean, started his career at 25. So when he can become top 10 richest guy by making 20% returns, I don't think so. It's first of all feasible to make more than that over such a long period of time. If he can make more than 12 or around 12 to 15% returns, it's more than enough. And that will be challenging, let me tell you. It won't be easy. Forget about dreaming about 25, 30, 40% kind of returns. Yeah. Now, this is what happens in India. A child is born, especially the grandparents and even the parents, they'll do an FD or an insurance for their child. Look at all the insurance policies which your grandfather or your parents did for you when you were born, or when you were like 2, 3, 5 years old. Look at the money you would have received now, or you're going to receive in next 2, 3, 5 years. Is that money huge? It will be nothing. You won't be able to even buy a car from that. Not even a decent, not even a medium-sized car. So what looks big 20 years back looks very small after later on, especially if the inflation, that the returns are not beating the inflation. Insurance is not beating inflation. FD is not beating inflation. You are eroding your wealth every year if you're investing in these asset classes. I'm not saying put everything into equity and real estate. What I'm saying is you should be aware of what you are doing and what you should expect. You have to divide your money into debt and equity both. But you should know that for long-term goals, only equity can beat inflation, and for short term, I can keep the money in FDs and other safe investments. So just to brief you about what we discussed in last few slides. So 1 lakh rupees per month, for example, someone who is spending 1 lakh rupees per month, a family of 4, it was a huge amount in 1980, right? 25 lakhs per month will be normal in 2016. Again, 25 lakhs per month looks big today, but that will be the kind of expenses people will have in India in 2060. That is 3 crore rupees per annum. So when your expenses goes from 1 lakh to 25 lakhs per month, that's an inflation of 8.4%. So you have to make at least 10% returns compounded annually in next 40 years, so that after paying taxes, you're able to beat the inflation of 8.4% in next 40 years. This is not government inflation. Again, this is your practical, your household inflation, your lifestyle inflation. So debt is risky in the long term, equity is risky in the short term. What do I mean by that? If you're investing in safe investment, debt means FDs and RDs and PPF and all these are debt investments. They are risky in the long term. Risky in the long term means they will not be able to beat the inflation, and you will never be financially free. So they are risky. They might sound safe today. For the short term, they are safe. But in the long term, something which is not beating inflation is not safe. And equity is so you should invest in equity market for long term and debt and in FDs for short term. People do exactly the opposite. Equities में जल्दी पैसा चाहिए, short term में लगाता है पैसा, और debt में 5 years, 10 years, FD, PPF 15 years, Sukanya Samriddhi Yojana 18 years, 20 years, 25 years. That's what you do. So you put in safe investments for long term, and in equity you enter and you try to gamble. Results are in front of you. So generating 12 to 15% returns, as I told you, on the entire wealth of yours on an average will be a challenge. And if you can do that, it will lead to abundance. We saw the numbers in the chart. So either you beat inflation or the inflation will beat you. One of you has to win. Yeah. Let's look at what happened to stock market. So when you look at stock market data, when SENSEX kahan ja raha hai, Nifty kahan ja raha hai. So SENSEX is a combination of top 30 companies of India, which are like the most saturated companies of India by size. And SENSEX is showing the price of those 30 companies put together. There's some back-end calculation, don't bother about that, but it is essentially showing what is happening with those set of 30 companies. So if you look at last 40, it started in 1986. SENSEX was introduced in 1986. So in last 34 years, returns of SENSEX has been 13.26% compounded annually. So without putting any brains, if you were just investing in those 30 companies of Sensex for last 40 years, last 34 years, you would have beaten inflation hands down without putting any brains. And those 30 companies keeps changing. I mean, 4 companies will go out, new 4 companies will come. So whatever happens, you just follow that, just copy that. This is till 2019 December. Now I'll show you for 31st March 2020. During that lockdown, we witnessed a sharp fall in the stock market. Even after that sharp fall, when it went below 30,000, returns as on 31st March 2020 of last 34.25 years were more than 12%. So even when you're investing for long term, and after that, even if there is a sharp fall in the stock market, your long term returns are not impacted because you've been investing for 10, 20, 30, 40 years. So just a difference. You see the last table, it was 13.26%, right? This is as on 31st December 2019. After 3 months, that is on 31st March 2020, market had a sharp fall within those few days, 1 week period. Even then the returns are 12.05. So hardly 1.25% returns have been reduced. That's why it's called magic of compounding. So 1% does make a lot of difference in the long term. So no matter how high the market is, if you're investing for long term, you will make money in the long term. Even if you invest at the peak most at the peak of the market. Yeah. So stock market grew in the last 34 years. Why? Because the Indian economy was growing. Now, one more economic concept. Stock market of any country in the world is a representation of its economy. It is not some casino going on in some Goa, in some place in a casino that where nothing has to be done with the Indian economy. No, whatever is happening in the economy, in the long term, the stock market will represent that. In the short term, it can go haywire. Like for now, I would say economy is not doing that well, but the market is going up. So that is not really matching the economy. But if you look at 15-year period, if economy is going from X to 2X, the market is bound to go from Y to 2Y. 2008, market went down by 60%, financial crisis, but the economy was growing by 7%. So it happens both the ways. In the short term, anything can happen, but in the long term, the stock market of any country is a representation of its economy. So if you believe in the Indian economy, the entire world believes in the Indian economy. By the way, look at the kind of investments which are coming in India. So if you believe in Indian economy, then invest in the market. Otherwise, don't. So you have to have this belief that Indian economy will grow in the future and that we will remain in the top 10 countries with respect to GDP growth. We might not grow at 7, 8, 9%, but even if we are growing at 4, 5% on an average in the next 10, 20 years, we will remain in top 10 countries because the rest of the countries are saturated. We keep complaining we don't have the growth we expect, but look at what is happening in other countries. It's always relative to other countries. It's not isolation in India. So we will remain in top 10 countries with respect to GDP growth rate in years to come, in our lifetime at least. So as I said, Sensex represents the top 30 companies, which is like relatively saturated. If you look at the returns of small and mid-sized companies, it was way higher compared to what you saw in the chart, 12 and 13%. So invest in stocks till you believe in the economy. The day you feel the Indian economy is gone for next 10 years, nothing can happen. You will go down the drain. Stop investing in stocks and real estate both, because these two asset classes will grow only when the economy grows in the long term. Otherwise, it will not grow. This is an economic concept. It is not to do with my opinion or your opinion. Yeah. So the simple formula is India grows is equal to stock market grows. And examples are developed countries. Look at the history of developed countries. You will know what happened there. So let me tell you what Warren Buffett said about US. He said over the long term, the stock market news will be good. In the 20th century, look at what all happened in the United States. They endured 2 world wars, quite a few other military and expensive military conflicts, the Great Depression of 1929, quite a few other financial panics, oil shocks, fly epidemic, that is mass case diseases, designation of disgraced president, that is basically political issues. Yet their Sensex, that is Dow Jones, went from 66 to 11,400. And right now it's at 30,000. So despite all these problems in the country, the market grew. Why? Because the economy was growing in the long term. Now what happens in India? BJP loses elections in some states, market goes down. surgical strike on Pakistan, market goes down. Something happening with China, market goes down. Trade war between China and US, market goes down. We need reasons to panic. COVID, whatever happened in that March end lockdown, market goes down. We all need reasons to panic. Rather, they are opportunities. If the market is going down, why? Because you know in the long run, economy will grow. Yeah. So all these are not moments of panic. All these are moments of opportunities. But yeah, you have to be a long-term investor. If you're looking at short-term money making, then you can do it in any period, and you can try your luck into that. So just to show you a small conversation with equity, and then we'll wrap up in a couple of slides. So equity says, I have delivered more than 12% annualized returns over the last 34 years. So investor response, not possible. I have lost my money almost all the time when I invested in you. Equity says, these are real data. You can check my track record. Yeah, you can check that. So investor says, then why didn't I make money? Here is the response. Equity, because you treated me like a passing affair and not married me. I can generate wealth for people who enter in long-term commitment with me, are loyal to me, and don't leave me in bad times. The most important part. In fact, in bad times, you invest more. March was a huge opportunity. It came after 12 years. 2008 was the last big opportunity. After that, it came in March. People end up selling their investments when the market is going down, thinking that everything will go, world will come to an end. If the world will come to an end, then it doesn't matter where your money is. What if it doesn't come to an end? So make use of that opportunity if it doesn't come to an end. Yeah. Let me check if you have any queries, you can post on the chat.
So I think a lot of people, since like all the webinars that we have, we always have this one question, and I think it's always there in every webinar, which is how do we start then when it comes to investing? Because all of us were in a rat race for so many years that get out of the college, get out of the school, get into the college, get out of the college, get a job, and then you sorted. Then
Yeah.
what exactly, like people like me, how can we start? Like my biggest achievement was to get into consultation and freelancing, and that's it. I've never invested really, and most of us haven't. So how do you propose that? Should we use apps like Grow or something, or should we genuinely start learning and reading about stocks and equity?
Good question, Uniti. So first of all, learning is of prime importance, even if you're going with an advisor. Because when you know the why behind something, when you are clear about why are you investing in equity market, and you know the basics about it, you can ask right questions to your advisor. You can have a meaningful conversation. I'm not saying become an expert. That's a full-time job. You have your own full-time job already. You have your full-time business, but at least start reading articles and books and keep in touch with that, so that you know what is happening and why you are doing something. Right. Secondly, I can see on the chat box also, where do we start, or how much do we how do we invest? So coming to your question, Unnati, before that apps like Grow or Zerodha Coin or whatever. See, these are just platforms. So it's like asking a question. I want to start an FD, fixed deposit. Where should I go? To HDFC Bank or ICICI or Kotak or SBI? There are only two things I look at. I look at the interest rate, and I look at the service of the bank, or service of how good the app is. Right. So it doesn't matter where which platform I'm using. It's important how I'm investing, whose advice am I taking, and how, am I clear about my concepts or not. Right. So the platform is not really important. All these platforms, in my opinion, are safe because they are highly regulated by SEBI. They have to pay a huge amount of deposit money to SEBI when they start, and they have all checks in place. So you don't have to worry about any of the platform, because even if the platform goes bust, even if the platform goes away, your money does not go away. Right? It's like you buy a property from a real estate broker. If the broker is not no more tomorrow, your property is still there, right? It's the same thing with your equity and your mutual fund investments. Yeah. Coming to how do we start, a couple of questions I can read in the chat box. Or how much do we invest? So I'll tell you what philosophy or what approach I follow. There is a formula called income minus savings is equal to expenditure. This is what I follow. Usually we do the other way around. Whatever we earn, we end up spending in the entire month, and we say whatever we are left with in the end of the month, on 30th of the month, I'll invest that. That never happens. Rather, you get your salary on first, second, third, or fifth of the month. The next day you invest whatever smallest amount possible, and the remaining you spend. Remaining you goes in expenses. So income minus savings is equal to expenditure. So that's how you start developing that habit of saving and investing, right? And uh, coming back to the chat box, how do we start, and how do see you can always start, if you want to start an equity market, you can start with mutual funds, or you can start with direct stocks as well. If you are not too comfortable with direct stocks, as I've seen a lot of people are not, you can always start with mutual funds, gain some experience, gain some learning about how the market works. After 1, 2, 3, 4, 5 years, when you become comfortable with equity market, the volatility and the fluctuation in the market, then you can start with stocks as well. That's how people usually do. They start with mutual funds and then they graduate to stocks, because they feel now they have got that understanding, they have got that comfort level with stock market, and they've got that risk appetite, and then they can start with stocks. Some people start with stocks from day one, some people start with stocks and mutual fund combined, so it's up to you. But always, in my opinion, though it might not be it would be biased if I say go with an advisor, because I am myself an advisor. But I do believe that this is a full-time job, whether you are a doctor or a CA or a lawyer or a financial advisor. It's a full-time job. You are also in a full-time job. I can never beat you in your job by doing doing that part-time. Similarly, you cannot beat me in my job by doing it part-time. That's how any industry works. So go with an advisor. You look around, look for people, take references, whatever way, whichever advisor you're comfortable with. Start small, start investing, start saving, and see for yourself how it goes. It takes some time to gain that experience and to get that comfort level. Yeah, whether it's comfort level with stock market or comfort level with the advisor.
Got it. I think in the previous webinar we had Hardik Lashkari with us, who said like open 2 bank accounts. पहले इनकम आती दूसरे बैंक अकाउंट में आप डाल दो कुछ एक segment like 10,000, 20,000, 40,000, whatever it is, and then forget it. Like, don't keep it in front of your eyes, else you will end up spending it. So that's very valid, that we should first save and then invest, like then spend. So yeah, point noted. Now the second thing is that you say that we can hire an advisor, but do these advisors also plan? Like, I know that you are working at a very high level, but if supposedly people in job or somebody who's freelancing, I can spare like 5 to 20,000 every month, depending on how the month was as a freelancer, and invest. Do you think such small amounts are also considered by people who consult other people with?
Yeah, so see, most of the people, when you go to a mutual fund advisor, that's a long conversation though, but I'll cut it short. You can start in mutual funds by 1,000 rupees per month, and the advisor will advise you, because they are playing on volumes. They have a team of theirs to do the back end work. They have X numbers of number of their investors. They can invest as low as 500 rupees per month also, and they will help you investing 5 lakh rupees per month also. There is nothing like that you have to have a certain amount of money, only then the advisor will entertain you. No, that's not the case. You'll be surprised. You'll be more than happy when you go there as a even whether you're a small investor or a big investor, doesn't matter.
Okay, makes a lot of sense. I think that helps a lot, because my only apprehension was that I don't get time after doing whatever I'm doing, and I think most of us don't. So getting help is actually good, but then help is at what cost? So, and one very small question, I'm not sure if this is relevant or not, but do these advisors in general take a part of your like return on investment, or do they have a fixed charge for it?
So that's what I was talking about, that it might be a long conversation. So in mutual funds, for example, there are two kinds of schemes by every fund house. One is a regular scheme, one is a direct scheme. So when you go to an advisor, he will make you invest in a regular scheme, because in that the 1% commission he will get from the company. So basically that mutual fund scheme will charge you around 2% commission every year on your total investment, out of which 1% they will give to the advisor. If you are someone who is doing your research on your own, right, in mutual funds, for example, then you can invest in the direct plan and you can save that 1%. So they will, the mutual fund advisor in this case, he will, in the first case, will not charge you any fees, because they are getting their commission from the company directly. Then there are second kind of advisors also who charge a fixed fee. They will say, I will charge you 5,000 rupees per annum or 10,000 rupees per annum. No matter how much you are investing, this is a fixed fee. And we will make you invest in the direct scheme where your charges will be only 1% because we are getting your fees from you. Right? So either the advisor will earn the money from the mutual fund company. In that case, they will make you invest in the regular plan of the mutual fund scheme, or the advisor will take a fixed fee from you and make you invest in the direct scheme. So that 1%, it should not be double charges, that I charge you a fixed fee also and I make you invest in the regular plan where I get 1% from the company also. It would be either of the two. So you have to choose which advisor. You can maybe choose 2 advisors in the beginning to diversify your advisory risk also. You can have 2 advisors and you look at their performance over long term and then maybe come down to one looking at the performance.
Got it. Makes a lot of sense.
So yeah, coming to this, since you talked about mutual funds, so I had something to share with the participants, as I shared with you over call as well. So there's something called Mutual Fund Excellence Program, which we are coming up within the month of December, on 11th of December. So basically, this is a 3 days live and interactive workshop costing only 499 rupees, including GST. And we are going to discuss how to shortlist equity mutual funds. It's only about equity mutual funds. How to monitor your portfolio. So you have selected schemes as one task, but after that, how frequently do you monitor that? What do you check? What do you don't check? That's more important. And thirdly, the most important is, when do you sell? So choosing the right mutual fund scheme or choosing the right stock is important, but exiting at the right time is equally important, right? So we'll discuss that. And having said that, some of you might say, I'll hire an advisor, why do I need to learn? So as I told you in the beginning, if you know the basics of what you are doing, what you're investing into, you can ask right questions to your advisor. You can have a more meaningful conversation. You can have a more healthy debate, rather than simply asking what returns kyun nahi aa rahe, why the returns low, or why the returns on this scheme is not good or that scheme is good. You can have a more meaningful conversation with your advisor. You can ask the right questions. This will also help you choose the right advisor, not only talk to your current advisor. I'll talk about the bonuses which we are giving free of cost along with this workshop in the next couple of slides. This is only about equity mutual funds. We have debt mutual funds, tax saving mutual funds, that is ELSS, and hybrid. Hybrid is a mix of debt and equity. We will not talk about that because equity itself is a huge ocean. It's happening on 11th, 12th, and 13th December, 2 hours each day, Friday, Saturday, Sunday. You can look at the time. Friday it's 8:30 p.m. to 10:30 p.m. and Saturday, Sunday 4:30 p.m. to 6:30 p.m. Yeah, this is happening in the coming month. Hardly 11 days to go. The bonuses I was talking about, you will get these 3 ebooks free when you join this program. I've just taken a screenshot from my website. Plus, you will get these 3 things as well. There's another ebook on how to be an effective reader. There is a company called Quico which helps you file your income tax returns. There's a discount on their services. Plus, I will have quizzes every day on those 3 sessions. And people, the top 3 winners will win a cash prize up to 3,000 rupees. So first prize is 3,000, second 2,000, third is 1,000 rupees. So that's what the cash prize I'm talking about here. And having said that, Unnati, this is something I did not share with you. Just for today and for the people who are online right now, just for the Loanwalle webinar, instead of 499, I'm going to charge only 399. That's almost
amazing. I think my team will also take a screenshot and add this.
Yeah, I'll just copy this and put it in the chat box so that people, and by the way, this link will be available only till today 12 a.m. After that, I'll disable this link, so you should take your call as soon as possible. After that, you can still go and register for the program, but that will be 499 rupees on my website. So I've put the link on the WhatsApp, on the chat. Sorry, Mutual Funds Excellence Program. You can go there and claim it for 399 only for next few hours. That is till 12 a.m. tonight.
That's great. And thank you so much, Anupam, for the offer, for the knowledge, for the ebook, and all these things. So I think personally, it was a much more मेरा खुद का स्वार्थ था for this webinar क्योंकि there was so many questions that I wanted to ask, but the PPT was so elaborate that I have got answers to most of my questions. Thank you so much for coming here. the whole team at Loanwalle is actually going crazy, because now we have got a hang of what investments are and everything. So we'll definitely check out your course as well as start reading and learning about it. And you're right, we have never heard that a person who has been investing in FDs or savings account becoming rich. So either it's real estate or stock market that will work for us. So yes, thank you so much for all that. Anybody who is in the webinar and wants to check out what Loanwalle does, do head to their website, and do head to Anupam's website for more such courses and updates. Thank you so much, Anupam, for joining. We had a great time.
Thank you. Thank you so much, Unnati. I'm not sure if people have any more questions. I cannot see that in the
yeah,
Q&A.
in case there are more questions and they come to us, like I've got 2-3 people who've pinged me on LinkedIn that they're not able to join or something. They had joined at the very end, but if they have any questions, we'll pass it on to you over email.
Sure. Sounds good. All right. Thank you so much, Unnati. Thank you, everyone.